Right now, inside the offices of every major general aviation lender in this country, something is happening that almost nobody on the pilot side of the industry is talking about openly. Loan officers who used to approve aircraft financing, with the kind of casual confidence that made you feel like you were getting a car loan, are now sending files to underwriting committees that didn't exist 2 years ago. Documentation requirements that used to be a one-page summary are now 12-page packages. Approvals that used to come back in 3 days are taking 3 weeks. And a meaningful number of deals that would have sailed through without a second glance are coming back with conditions attached, or not coming back approved at all. This isn't something lenders are advertising. You won't find a press release that says we've tightened our aircraft lending standards because our risk models told us to. What you find instead is loan officers who are suddenly a lot more careful about what they tell a buyer to expect before the paperwork goes in, dealers who are watching deals fall apart at the financing stage in ways they weren't seeing 18 months ago, and buyers who walked into a lender conversation with strong credit and genuine assets and walked out with a loan that looked nothing like what they expected, or with a polite decline and a confused look on their face. If you're in the market for an aircraft right now, or planning to be in the next year or two, or you own one and you're thinking about refinancing, this is the story you absolutely need to understand before any of that happens, because the shift is real, it's material, and it is not going away anytime soon. Before we get into the mechanics of what's actually changing and why, hit subscribe right now, because what I cover here is the financial and market reality of general aviation, not the airshow version, not the marketing brochure version, the actual numbers and decisions version that affects what you can buy, what it costs you to borrow money to buy it, and what that airplane is worth on the other end. If that kind of information matters to you, this is exactly where you want to be paying attention, and you don't want to miss what's coming next. Let me set the stage before we get into the specific ways lending has tightened, because if you don't understand the environment that produced this shift, the individual changes feel random and unconnected, and they aren't. They're all downstream of the same set of forces converging at the same time, in a way the aviation lending market genuinely hasn't seen before, at least not in quite this combination. General aviation aircraft lending has always been a specialty niche. It's not like mortgage lending, where every major bank in the country has a product, and a department, and a set of secondary market buyers for the paper. Aircraft loans are typically originated and often held by a much smaller universe of lenders, a handful of specialty aviation finance companies, some community banks and credit unions with strong aviation communities in their footprint, a few larger regional banks that have built aviation desks over the years, and occasionally a manufacturer's captive finance arm. Because the universe is small, when the risk appetite of the major players in that universe shifts, the effect on the broader market is much faster and more complete than it would be in a bigger lending category where there are hundreds of competing lenders offering alternatives. When the 3 or 4 dominant aviation lenders all get more cautious at roughly the same time, there's nowhere else to go that looks meaningfully different, and that's exactly the situation the market finds itself in right now. The second piece of context you need is what's happened to aircraft values over the last several years, specifically the volatility of those values, because lenders think about aircraft collateral in a way that a buyer doesn't necessarily think about an airplane he wants to fly. When you're buying an airplane, you're thinking about what it does for you, where it takes you, what it feels like to fly it, whether it fits your mission. When a lender is approving a loan secured by that airplane, they're thinking about one thing, which is what that airplane is worth if they have to take it back and sell it. And the answer to that question has gotten genuinely complicated in ways it wasn't 5 years ago. During the pandemic era, used aircraft values went on one of the most aggressive appreciation runs in the history of general aviation. Airplanes that had been sitting at stable, predictable valuations for years suddenly jumped 20, 30, 40% in price, in some cases more, as a wave of new and returning pilots entered the market. At the same time, inventory was tight, and interest rates were still low enough to make financing look attractive. Lenders who were approving loans in that environment were doing so against collateral that was actively appreciating, which is a lender's version of a good dream, because even if a borrower defaults, the collateral is worth more than when you wrote the loan. That environment is over. Values that ran up hard are in various stages of correction depending on the category, and the pace and direction of that correction have been genuinely difficult to model in advance. Some categories have held up relatively well. Some have given back a meaningful chunk of their pandemic gains. Some are still declining slowly, as inventory has loosened up and buyers have gotten more selective, and some are caught in the middle of a collision between new aircraft pricing pressure and used aircraft supply that's hard to read from one quarter to the next. All of that uncertainty, That inability to confidently project what a given aircraft category is going to be worth in 3, 5, or 7 years is poison to a lender's collateral assumptions, because a lender writing a 7-year loan on an aircraft today needs some reasonable confidence in where that aircraft's value is going to sit for the life of the loan. And right now, that confidence is genuinely hard to have across a lot of aircraft categories. Add to that the broader economic backdrop. Interest rates moved dramatically and quickly, creating a payment shock on aircraft loans that made buyers more fragile financially than they looked on paper. A borrower who qualified comfortably for a loan at 3.5% may find themselves stretched more than they anticipated at 7%, and lenders writing loans in the current rate environment are acutely aware that if rates were to rise further, or if the economy were to soften meaningfully, they could be looking at a book of loans on borrowers who are more payment sensitive than their credit scores suggested when the loan was written. That awareness is baked into how underwriters are looking at debt-to-income ratios, liquid reserve requirements, and the overall financial picture of every borrower who walks through the door right now. And then there's the insurance piece, which we've talked about in other contexts, but which matters enormously to lenders specifically. Every aircraft loan has a requirement for hull insurance coverage because the loan is secured by the aircraft, and if the aircraft is destroyed or damaged beyond repair, the lender needs to be made whole from an insurance payout, not from a defaulted borrower with no airplane left to sell. When insurance availability and premiums for GA aircraft started moving in ways we've discussed at length in other videos, lenders started having to think about something they previously took almost for granted, which is whether the borrower is going to be able to maintain required insurance coverage for the full term of the loan. If a borrower can qualify for the loan but runs into an insurance situation that forces them to either fly without proper coverage or stop flying the airplane entirely, neither of those outcomes is good for the lender holding the paper. So insurance availability has become a genuine underwriting variable in a way it wasn't when GA hull insurance was plentiful and predictably priced. That's the environment. Now let's get into the actual mechanics of how lending has changed, because this is where it gets specific and practical in ways that matter if you're trying to finance an airplane in the current market. The first and most visible change is in loan-to-value ratios, and this one surprises a lot of buyers who are used to how aircraft lending worked during the more permissive years. Loan-to-value is exactly what it sounds like, the ratio of the loan amount to the appraised or book value of the aircraft being financed. At peak permissiveness, it wasn't hard to find lenders who would go to 85 or even 90% loan-to-value on the right aircraft and the right borrower, meaning you could put 10 or 15 cents on the dollar down and borrow the rest. That's still more conservative than residential mortgage lending at its loosest, but for an asset that depreciates and doesn't have a fixed location the way a house does, it was genuinely generous. What's happened across most of the specialty aviation lenders over the last 12 to 18 months is a quiet but meaningful drift downward in maximum loan-to-value, particularly on aircraft that fall into higher-risk collateral categories. We're now seeing a lot of lenders settling in at 75 or even 70% loan-to-value as a practical ceiling for many aircraft types, which means a buyer who was planning on a 15% down payment and built their deal around that number is now being asked for 25 or 30% instead. On a $300,000 airplane, that's the difference between a $45,000 down payment and a $90,000 down payment. That's not a rounding error. That's a deal killer for a meaningful percentage of buyers who had the income to carry the monthly payment comfortably, but don't have that much additional cash sitting around. The specific categories getting hit hardest on loan-to-value are exactly the ones where value volatility has been highest. High-time aircraft with avionics that are starting to age out, airplanes in categories where the used market softened the most from peak, specific aircraft models where parts or maintenance support has become a genuine concern over the last few years, and any aircraft where the lender's collateral desk isn't confident the book values being used are keeping up with real market transactions. That last point is more important than it might seem, because aircraft valuation guides have historically lagged real market conditions by meaningful periods of time, and a lender who's been burned by lending against book value, only to discover the real market is 15% below book when they try to resell a repossessed aircraft, is going to start requiring independent appraisals and discounting from book more aggressively going forward. The second major change is in the documentation and borrower scrutiny standards, and this is where the shift feels most dramatic to buyers who went through the process even 2 or 3 years ago. Aviation lending was never the most document-intensive borrowing experience, partly because the borrower pool has historically skewed toward high-income, high-net-worth individuals whose creditworthiness was relatively unambiguous, and partly because the specialty lenders who dominated this space built their underwriting processes in an era when they knew their borrowers personally in a way that a faceless national bank doesn't. A buyer with a 780 credit score and a strong income used to be able to get through the aviation lending process with documents that would have barely scratched the surface of a commercial mortgage underwriting. That's not what the process looks like anymore, at least not at most lenders for most loan amounts. What's become much more common now is 2 full years of personal tax returns, not just income statements, but the full returns with all schedules. Specifically because underwriters want to see what the reported income actually looks like after business deductions and depreciation, and all the ways that successful self-employed individuals and business owners legitimately reduce their taxable income. A buyer who reports $150,000 in annual income after all deductions may have a very different financial picture than someone who earns the same gross income as a W-2 employee, and lenders are increasingly treating those situations differently in terms of what they need to see before they'll approve. Business owners, who make up a disproportionately large share of GA aircraft buyers, are getting the most intense scrutiny here, and it's worth understanding exactly why. Because it's not that lenders have suddenly decided that business owners are less creditworthy. What's happened is that lenders are much more focused on the quality and durability of income rather than just its size. A business owner with a profitable company, reporting strong earnings in 2022 and 2023, may have a different picture in 2024 and 2025 if their industry was sensitive to the rate environment, the construction sector, commercial real estate, interest rate-sensitive service businesses, manufacturing businesses dealing with input costs. The list goes on. Lenders are asking for more current financial information, sometimes requesting quarterly profit and loss statements rather than just annual tax returns, specifically because they've gotten nervous about the gap between what a tax return showed a year or two ago and what the borrower's actual current financial situation looks like. That extra layer of scrutiny takes time. It generates friction, and it's producing surprising outcomes for buyers who would have sailed through the same process just a few years back. Liquid reserve requirements are the third major change, and this one is particularly important for buyers who are planning to put a significant down payment down and stretch themselves to do it. Lenders have historically required some level of post-closing liquidity, basically confirming that after you make the down payment and cover closing costs, you still have some meaningful amount of liquid assets left, enough to demonstrate that you're not betting everything on the purchase and are left financially fragile. The specific number has always varied by lender and loan size, but the general principle is consistent. What's changed is how much post-closing liquidity is actually being required, and in some cases, how that liquidity needs to be documented and structured. We're now seeing requirements that look like 6 months of full loan payments in liquid, accessible reserves as a floor, and for larger loan amounts on higher-value aircraft, those requirements can be more substantial than that. For a buyer putting 25 or 30% down on a $400,000 airplane and then being asked to demonstrate another $70,000 to $80,000 in liquid reserves on top of that, the total capital required to close the deal is getting surprisingly large, and it's catching people off guard who planned their purchase around the down payment alone and didn't fully account for the reserve requirement on top of it. The fourth change involves what's happening specifically with aircraft type and category restrictions that some lenders have started implementing quietly without making any formal public announcement. This is where the tightening starts to look less like uniform risk management and more like specific collateral categories that lenders have decided they simply don't want on their books right now, or that they'll only take on at terms that effectively price many buyers out of the loan. High-performance turbine aircraft, specifically owner-flown jets and turboprops being financed for personal rather than commercial use, have gotten meaningfully harder to finance in the last year to 18 months. Part of this is the insurance issue we already mentioned, but part of it is also a pure collateral concern. The market for turbine aircraft in specific categories has been lumpy enough in terms of value that lenders are requiring higher down payments, shorter loan terms, and in some cases, additional financial covenants that essentially require the borrower to maintain a minimum financial profile for the life of the loan. Some lenders who were doing these loans freely 2 or 3 years ago have effectively stopped doing them entirely for borrowers who don't fit a very narrow profile. Experimental amateur-built aircraft, which represent a genuinely significant portion of the active GA fleet, have gotten harder to finance across the board, not because they're bad airplanes, A well-built experimental, with proper documentation and a strong maintenance history, can be an excellent aircraft. But because the collateral is harder to value, the regulatory framework is different from certified aircraft, and the resale market, while real, is thin enough in most categories that lenders aren't confident they can move one if they have to. Many specialty aviation lenders who would do experimental financing a few years ago have quietly stopped, or have added conditions around things like kit brand, aircraft age, total time, and build quality documentation that effectively eliminate most of the experimental fleet from consideration. Older certified aircraft, meaning specifically aircraft that are crossing into the age ranges where certain avionics begin to require attention, where airframe component life limits become relevant, and where parts and maintenance support networks have started to thin out for discontinued models, have also seen meaningful tightening. The practical reality for some of these aircraft is that a lender who picks one up through a repossession may struggle to find a buyer at a price anywhere near the loan balance, partly because the airplane needs work that the distressed buyer couldn't or wouldn't do, and partly because the market for older complex aircraft has gotten selective enough that even well-maintained examples are taking much longer to sell than they used to. A lender who has to carry a repossessed 1970s retractable single in their asset book for 6 months, while the market decides what it's worth, is in a very different position than a lender holding a 3-year-old single-engine piston with a full avionics stack that a dozen buyers would look at in the first week. The fifth major area of tightening is specifically around the use case verification that lenders are starting to require, and this is one that touches some buyers in ways they genuinely don't expect. Aircraft loans for personal use are structured and underwritten differently than aircraft loans for commercial or business use, and the distinction matters for a variety of reasons, including tax treatment, insurance requirements, and the lender's assessment of how the aircraft is going to be used and maintained. What's happening now is that lenders are getting more serious about actually verifying that the use case a borrower describes matches reality, and they're incorporating future use expectations more explicitly into their underwriting. What does that actually look like in practice? It looks like lenders asking specific questions about where the aircraft will be based, whether it will be available for charter or rental, how many hours per year the borrower anticipates flying it, and what training and recurrent requirements the borrower has either completed or plans to complete. It looks like some lenders starting to cross-reference insurance quotes against stated use cases, because an insurance application for personal-only use on an aircraft that the borrower told the lender will fly 300 hours a year for business purposes raises consistency questions. It looks like a few of the specialty lenders starting to ask for professional pilot certificates or documented flight experience as a component of the underwriting on higher-value aircraft, not as an absolute requirement, but as a factor in the risk assessment, which has never been part of the traditional lending criteria. The sixth change is in loan term availability, which matters more than buyers sometimes realize, because loan term affects monthly payment directly, and for many buyers in the current rate environment, the monthly payment math is genuinely tight. Longer loan terms mean lower monthly payments, which means more buyers can qualify on payment-to-income criteria. Shorter loan terms mean higher payments, which means fewer buyers can qualify. For years, aviation lenders were fairly generous on terms, offering 15 or even 20-year loan terms on high-quality aircraft that would hold their value well enough to support that duration of amortization. Those longer terms are becoming much harder to find. What the market looks like now for most lenders is a practical ceiling, closer to 12, maybe 15 years, for the best collateral and strongest borrowers, with a meaningful drift toward 10 years as a standard for many aircraft categories. That might sound like a subtle shift, but the payment impact is real. The same principal amount, at the same interest rate, financed over 10 years instead of 15, produces a monthly payment that's roughly 40% higher. For a $200,000 loan, that's the difference between a monthly payment in the $1,600 range and one closer to $2,200. That gap eliminates a real portion of otherwise qualified buyers who could carry the 15-year payment comfortably, but genuinely cannot make the 10-year payment work in their monthly budget without significant financial strain. The reason for this isn't arbitrary. Lenders shortening terms is a direct response to collateral value uncertainty over time. A lender who's nervous about where a specific aircraft category is going to be valued in year 12 or year 15 of a loan term can mitigate that uncertainty by requiring the loan to be paid down faster, which means the outstanding balance is smaller relative to collateral value at every point in the loan life. If the borrower defaults in year 8 of a 10-year loan, the lender is in a much better collateral position than if the borrower defaults in year 8 of a 15-year loan, where the amortization has been much slower. Shorter terms are a form of collateral protection that lenders are using because they don't have confidence in the long-run value trajectory of certain aircraft categories, and that lack of confidence is the direct downstream effect of the value volatility we described earlier. The seventh shift is around what's happening with how lenders are treating aircraft purchased from private sellers versus those purchased through dealers, and this is worth understanding because a large and growing percentage of GA transactions are private sales, especially as buyers look for deals relative to dealer pricing. Lenders are starting to treat these two transaction types differently in important ways. A private party purchase requires the lender to rely entirely on external valuation, because there's no dealer who's taken a position on the aircraft's value through a market price, done a pre-purchase inspection, put together a title search, and organized the documentation. All of that falls to the buyer and the lender to verify independently, which means the lender is doing significantly more work and taking on more collateral risk than in a dealer transaction. The response to that reality has been to require more robust independent appraisals, to be more conservative about lending against stated transaction prices that don't match book values, and in some cases, to charge a slightly higher interest rate for private party transactions to compensate for the additional risk and administrative burden. For buyers who found a good private deal and are counting on financing to make it work, this can create a frustrating situation where the deal they've found is legitimately attractive, but the lender's more conservative appraisal of the specific airplane, based on its actual condition, its maintenance records, or the current state of its particular market segment, comes in below the agreed purchase price in a way that forces a larger down payment or a renegotiation of the deal itself. That dynamic is playing out increasingly often in the current market, especially in aircraft categories where the gap between optimistic seller pricing and realistic lender valuations has been growing as values softened from peak. The eighth major change is around the specific treatment of avionics and equipment, and this one is genuinely interesting from a technical standpoint. For decades, aviation lending valued aircraft primarily as airframe and power plant combinations, with a fairly stable relationship between age, time, and value that could be referenced against standard guides with reasonable confidence. The avionics in a given aircraft were nice to have. They affected price at the margins, but the core value was in the certified airframe and engine. That relationship has gotten much more complicated because the avionics installed in a modern GA aircraft can represent an extraordinarily large percentage of the aircraft's total value. A basic certified piston single with a complete glass panel retrofit, WAAS GPS, coupled autopilot with envelope protection, traffic and weather systems, ADS-B, and a decent interior might have $200,000 or more of equipment installed in an airframe that was worth $100,000 before any of it went in. From a performance and utility standpoint, that's a transformed airplane. From a collateral standpoint, it's a headache because avionics depreciate differently than airframes. The labor to remove and reinstall them in another aircraft is significant and doesn't fully track with the value retained in the equipment itself. And the compatibility constraints between specific avionics systems and specific airframes mean that the equipment doesn't necessarily transfer value cleanly if the lender has to take back and resell the aircraft. The practical effect is that lenders have gotten more cautious about lending against the full retail value of a heavily avionics-equipped aircraft, particularly one where the ratio of avionics value to airframe value is very high. Instead of lending against the full sticker price of a nicely equipped airplane, some lenders are now applying a discount factor to the avionics component, in effect treating that portion of the value as less reliable collateral than the airframe component. For a buyer who's purchasing a heavily equipped aircraft and expecting to finance it against the full purchase price, this can create a gap between what they expected to borrow and what the lender is actually willing to lend. Ninth, and this is a change that hasn't gotten nearly as much attention as it deserves, there's a significant shift happening in how lenders are assessing refinance requests, and the implications for current aircraft owners are real and important. Refinancing an aircraft loan has historically been a fairly common transaction, particularly when interest rates were falling, when an owner wanted to restructure a shorter-term loan for better cash flow, or when someone had built equity through appreciation and wanted to access some of it. The general assumption in the GA community has been that as long as you've been paying your existing loan on time, refinancing shouldn't be dramatically different from the original underwriting. That assumption is getting tested. What lenders are finding when they look at refinance requests is that a meaningful number of aircraft purchased during the pandemic-era appreciation window are now carrying outstanding loan balances that are above or close to current market value of the aircraft, because values have come down from peak while the loan balance has declined only slowly during the early years of amortization, when most payments go to interest. A borrower who bought a used aircraft at peak valuation with an 80% loan-to-value ratio made 2 years of payments and now has an aircraft that's declined in value by 15% from when they bought it, could easily find themselves in a situation where their outstanding balance exceeds their aircraft's current value. A lender being asked to refinance that loan is effectively being asked to start a new loan on collateral that's already underwater, and the answer to that request is increasingly no, or not without the borrower bringing significant cash to the closing to cure the deficiency. This is a genuinely serious situation for a segment of the borrower population that nobody was really talking about loudly when values were still riding their peak. The conversation about what happens when aviation values mean revert from their highs has been happening quietly among lenders and dealers for a while now, but it's starting to show up in real transactions in the form of refinance requests that can't be processed without the borrower covering an equity gap they didn't expect to have. 10th, and this is where everything comes together in a way that's worth sitting with carefully. The cumulative effect of all of these individual tightening actions across different dimensions of the lending process is a fundamental shift in who can actually access aircraft financing under the terms that make airplane ownership economically workable for them. It's not that aviation lending has stopped or that any particular borrower type has been formally excluded. What's happened is more subtle and in some ways more consequential, which is that the effective cost of access to aircraft credit has gone up significantly for a wide range of buyer profiles, and the process of getting it has gotten complicated enough that a meaningful percentage of people who would have successfully financed an aircraft 2 or 3 years ago are either not getting approved on terms that change the economics of ownership in ways they weren't expecting, or giving up partway through a process that's become significantly more friction-intensive than it used to be. That's not the aviation lending story that gets told at the airshow static displays or in the aircraft finance booths at fly-ins, where the pitch is still designed for an environment that's substantially more permissive than the one that actually exists right now in underwriting rooms. The pitch hasn't caught up to the underwriting reality, and the gap between those two things is causing real pain for real buyers who walked into the financing process with expectations calibrated to the old environment. Let's talk about why the lenders themselves are in the position they're in right now, because it's worth understanding the lender's perspective here, rather than just viewing this as a one-sided tightening that's happening to buyers. These are specialty financial institutions with concentrated portfolios in a single asset class, and the risk dynamics of that concentration are very different from a large bank with a diversified loan book. When you're a specialty aviation lender and your entire loan portfolio is aircraft, you don't have the cushion of diversification that protects a larger institution. If general aviation values move meaningfully against you, you feel all of it, not a small slice of it. The aviation lenders who were most aggressive during the boom years wrote a lot of loans at high loan-to-value ratios against collateral values that were at historic highs, and the combination of those high values, subsequent value softening, and a rising rate environment that makes it harder for buyers to afford the monthly payments is creating a default risk picture that is genuinely different from what these lenders were underwriting for when those loans were written. When you look at a loan book with that profile, and you look at the economic outlook, and you look at what's happening with insurance availability for your collateral, and you look at the value trajectory of the aircraft types you're most heavily exposed to, tightening makes complete rational sense from a portfolio management standpoint, even if it's frustrating for every buyer who gets caught by it. There's also a competitive dynamic among the lenders themselves that's worth understanding, because it's changing how they're behaving relative to each other. During the years when the aircraft finance market was booming and every deal was good, there was meaningful competition among the specialty lenders, which was generally good for borrowers because competing lenders will push each other toward better terms, lower rates, and higher loan-to-value ratios to win the business. That competitive environment kept the entire market more permissive than any individual lender's pure risk preference would have produced, because a lender who was more conservative than its competitors simply lost deals to those competitors rather than writing the deals it was willing to do. When risk appetites shift simultaneously across most of the major lenders, which is what's happening now because they're all reading the same market conditions and getting the same actuarial signals, that competitive pressure to be permissive, eases off dramatically. When the lender who would have competed away your deal by offering better terms is now also tightening at roughly the same time, the disciplining effect of competition weakens, and the market can move toward more conservative terms faster than it would if the players were still meaningfully divergent in their risk appetite. That's part of why the shift has felt relatively sudden to buyers, because when all of the major players in a small market tighten at roughly the same time, the buyer experiences it as the entire market moving at once, rather than as one lender being more conservative than another. Now let's talk about what this means practically if you are actually in the market right now or planning to be soon, because I don't want to leave you with a picture of a locked-up market where financing simply doesn't exist. It does exist. Deals are getting done, but the preparation and approach required to navigate this environment successfully is genuinely different from what it would have taken 2 or 3 years ago, and knowing the difference in advance is worth real money. The single most important thing you can do before you start seriously shopping for an aircraft right now is talk to a lender first and get a real, detailed understanding of where you stand before you fall in love with a specific airplane. Not a quick conversation where you get a rough yes based on your credit score. A real underwriting conversation where you share your actual financial documentation, your income profile, your liquid assets, your existing debt obligations, and ideally, the general category and price range of aircraft you're considering. The goal is to come out of that conversation knowing your realistic loan-to-value ceiling for the category you're looking at, your likely interest rate range based on current market conditions, the reserve requirement you'll need to have available after closing, and any specific documentation you'll need to gather that might take time to assemble. If you're self-employed or a business owner, start pulling together your 2 most recent full personal tax returns before you do anything else, because that's going to be required, and you want to know in advance if there's anything in those returns that's going to raise questions you need to have answers ready for. If your business income shows significant year-over-year variation, or if your adjusted gross income after business deductions is meaningfully lower than your actual cash flow, be prepared to explain that clearly and have supporting documentation. The lender isn't assuming you've done anything wrong, but they need to understand what's real income that can service a loan, and anything that requires explanation goes smoother if you've thought it through in advance, rather than being surprised by the question. Get your liquid reserves in order and document them before you need them. Lenders are going to want to see bank and brokerage statements going back enough months to verify that the assets are genuinely yours, aren't just temporarily parked for the purpose of the application, and are actually accessible if you need them. If you have assets that are somewhat illiquid, like money in retirement accounts that are technically accessible but with penalties, understand in advance whether and how your lender will count those toward reserve requirements, because the answer varies by lender and by circumstance, and it can affect your reserve picture significantly. Think carefully about your down payment strategy in the current environment, because putting a larger down payment down than you strictly need to qualify does something important beyond just reducing your monthly payment. It positions you at a lower loan-to-value ratio that moves you into more comfortable underwriting territory, potentially increases your access to better loan terms, and provides a cushion against the collateral value uncertainty that's making lenders nervous. In a market where aircraft values are uncertain, being at 60 or 65% loan-to-value instead of 75 or 80 is not just about the payment, it's about being in a fundamentally stronger position with your lender throughout the life of the loan and reducing your exposure to the refinancing problems we discussed earlier. Get an independent appraisal done on any aircraft you're seriously considering purchasing, and do it before you make an offer that you expect your lender to finance at a specific number. I know this costs money and takes time, and I know that in the old environment plenty of buyers got through without doing it, because lenders were comfortable with book values. The current environment is different. A lender who comes back with an appraised value below your purchase price right before closing creates a deal-killing crisis. An appraisal you've already got in hand before you finalize the deal gives you either the confidence to proceed or the information you need to renegotiate. Either way, you're in control of the process, rather than being surprised by it. On the insurance question specifically, and this cannot be overstated given everything we've covered about how central insurance has become to this whole picture, talk to an aviation insurance broker and get a real, specific quote on the aircraft you're considering, based on your actual certificate, ratings, and logged hours, before you have any significant money committed to the deal. Not a rough estimate, an actual quote that your broker is willing to stand behind. The number that comes back may affect your decision about whether to proceed with that specific aircraft, whether to invest in additional training before the purchase to get your insurance profile into better shape, or whether to consider a different aircraft category where your insurance outcome would be better. All of those decisions are much easier to make before you've signed a purchase agreement than after. If you're looking at aircraft categories where the tightening has been most severe, specifically turbine aircraft and older complex singles, consider whether you have lender relationships that are worth cultivating specifically for this purchase. The specialty aviation lenders who are still doing these loans tend to be relationship-oriented institutions where a borrower who comes in with a strong financial profile, a clear and credible aircraft ownership plan, and the right level of flight experience and training documentation is going to get a meaningfully different hearing than a cold application from someone the lender has never dealt with. If your local community bank or credit union has an aviation portfolio, it's worth having that conversation early, because an institution that knows you and has seen your financial profile in another context, a mortgage, a business loan, a prior relationship of some kind, has a different risk assessment starting point than a lender encountering you for the first time. For buyers who are genuinely at the margin of qualifying in the current environment, meaning you can make the monthly payment work, but the down payment or reserve requirements are a stretch, it's worth having an honest conversation with yourself and your financial advisor about the full cost of aircraft ownership in the current environment before you commit to it. The purchase price and the loan payment are the largest and most obvious line items, but they're far from the only ones. Insurance premiums, hangar costs, maintenance and annual inspection costs, avionics subscription fees and database updates, engine reserves if you're approaching major maintenance intervals, these things add up to a number that's genuinely substantial even after you've made your down payment and started writing loan checks. The lender who approves your loan is only assessing your ability to make the loan payment. Nobody in the transaction is formally responsible for making sure you've accounted for the full cost of ownership. And in the current environment where everything in the ownership cost stack has moved up, the gap between what a loan payment costs and what an airplane actually costs to own well has gotten wider than it used to be. Know that gap before you buy, not after. Let me talk about what's happening on the refinancing and existing owner side of this for a moment, because there are people watching this who already have an aircraft financed and are wondering how this environment affects them, even though they're not actively buying right now. If your aircraft loan was written in the last 2 or 3 years at a high loan-to-value ratio on a category that has seen meaningful value softening, it's worth getting an independent appraisal to understand exactly where you stand on equity right now. The question isn't whether your value declined dramatically, it's whether the combination of your original loan amount, the speed of your amortization, and the magnitude of value change in your category has left you in a position where you have less equity than you think, or in an underwater situation that hasn't surfaced yet because you haven't needed to refinance or sell. Knowing your actual equity position matters because it affects everything, from your insurance conversation, where agreed hull value can diverge from market value in ways that affect your coverage, to your lender's perception of your account if you needed any kind of loan modification or restructuring. If you're approaching the end of a short-term balloon payment structure on your existing loan, which some aviation loans have, where the note matures and requires refinancing or full payoff after 5 or 7 years, even if the amortization schedule assumed a longer term, start the refinancing conversation early and understand your options before you're under time pressure. The refinancing market we've described is not shut, but it requires lead time and potentially some financial structuring work that you can't do in 2 weeks if a balloon payment is coming due. If you're current on your loan and have meaningful equity in your aircraft, the main thing to monitor is whether your insurance situation is creating any risk of covenant violation with your lender, since most aircraft loans require hull coverage at or above the outstanding loan balance, and a failure to maintain that coverage creates a technical default even if you've never missed a payment. In the current insurance environment, where premiums have moved and some coverage scenarios have gotten complicated, verifying that your coverage is fully current and properly structured relative to your loan requirements is worth a periodic check rather than something to assume is fine because you haven't heard otherwise. Now I want to step back and look at where all of this is pointing directionally, because the individual changes we've described are all real and important in themselves. But the bigger question for anyone trying to make decisions about aircraft ownership over the next 2 to 5 years is whether this tightening is a temporary response to a specific set of unusual conditions, or whether it represents a more durable structural shift in how aviation lending works going forward. My honest read is that it's somewhere between those two things, and understanding the difference matters. Some of what we're seeing is genuinely cyclical, tied to the specific interest rate environment of the last several years, the specific value volatility coming off pandemic peaks, and the specific economic uncertainty affecting the demographics of aircraft buyers right now. As rates stabilize, as values find their equilibrium, as the actuarial picture of GA risk gets clearer for underwriters who are currently navigating a lot of uncertainty, some of the tightening will ease. Loan-to-value ratios will probably drift back up for the categories where collateral values stabilize and strengthen. Term availability will likely expand again as lenders get more comfortable with long-run value projections. Documentation requirements may ease for borrower profiles that clearly don't need the extra scrutiny once the broad caution of this moment passes. But some of what we're seeing is structural and is not going back to where it was, and it's important to be clear-eyed about that. The insurance market for GA aircraft has changed in ways that are embedded in actuarial tables, reinsurance structures, and underwriting logic that doesn't